Hi, this is Benjamin Lavine, Chief Investment Officer with 3D Asset Management. This is our third quarter 2017 market commentary where we'll be highlighting the major performance drivers of market performance over the last quarter. This session is being recorded. Afterwards, if you have any questions, feel free to email us or contact us and we can set up a separate call to answer your questions. First, a disclosure. So if you were able to sleep through August of this year, then you may perceive the third quarter as somewhat uneventful. But if you had stayed awake, then you probably felt like you ate a volatility sandwich with a big meaty dose of August volatility sandwiched between two slices of near record low volatility. July saw the VIX, or the implied volatility priced into S&P options, reach new depths. But then risk appetite took a sharp turn for the worst in August, following saber rattling between the U.S. and North Korea, President Trump's comments following the Charlottesville protests, and heavy flood damage in Houston and Florida from hurricane activity. However, risk appetite recovered from the August scare that saw the VIX spike to 15 to 16% from a low of 9 to 10%, and high-yield spreads had widened 50 basis points from the 3.1% lows seen in July. Investors who flocked to risk havens, such as long-duration treasuries, had been anticipating a worst-case scenario of property casualty damage to the southeast region from Hurricane Irma. But the hurricane turned westward and inland, resulting in a loss of strength and lesser damage than what could have resulted if the hurricane tracked along the eastern coast. Despite the damage the hurricane caused for much of Florida, damages came in below estimates, which resulted in a relief rally led by financials, especially insurance stocks. Treasury yields began to rise as investors saw the green light to exit the safety trade and re-enter the risk trade. Following hawkish comments from the Federal Reserve, the sell-off in treasuries accelerated as the 10-year treasury yield spiked to 2.33% at quarter end. Following the Fed's reaffirmation of its near-term outlook on growth and inflation, recent inflation declines considered transitory, such as mobile pricing plans, the Trump administration and congressional leaders released their blueprint for tax reform, which seeks to lower the corporate tax burden to make it more competitive globally, as well as simplify the tax code. Small caps, which had been lagging for the better part of the year, sharply rallied into quarter end. So at this point, what we can say is that earnings are going to be the main driver of market performance going forward, with pretty much everything else being treated as noise. DC can drive near-term volatility, but what matters over the longer run in this cycle is at least what the earnings advance is going to look like. According to the September 29, 2017 FactSet Earnings Insight Report, the consensus S&P earnings growth for third quarter 2017 is expected to be 4.2%, led by a recovery in the energy sector, and analysts expect earnings to grow 8% over the next 12 months, driven by consumer and technology sectors. Analysts expect some weakness due to hurricane activity, but the cuts to third quarter estimates have trended below the long-term average. For all of 2017, analysts expect S&P earnings to grow 9.6% on top of revenue growth of 5.7%, which has been consistent throughout the year. So barring any other major negative surprises on the geopolitical front or from DC, sentiment does remain positive as we're about to enter the fourth quarter, which has typically been seasonally strong for equities. This is something that we've done for the last couple of quarters, a theme that we've been talking about since the beginning of the year, this concept of renormalizing the new normal. And in the first quarter commentary, we asked what we believe are three structural questions concerning this current cycle in the face of secular disinflation caused by aging demographics, high debt levels, and excess global capacity. So are the cyclical forces succumbing to secular disinflation? That's what it appeared to be in the second quarter. This quarter, it's seen kind of a bit of a turnaround in prospects. The first question we asked was, can the incoming U.S. administration reverse the new normal overhang on U.S. business production, and how will such a reversal manifest itself? Well, what we've seen so far, at least from the administration, is not much, apart from changes being made behind the scenes on the regulatory front. But with healthcare reform legislation stalled, all eyes are now on the federal budget and tax reform legislation. And the second question we asked was, will a new round of inflation be unleashed as the new administration seeks to roll back government policies regulating large swaths of the industrial sector, freeing up pent-up growth, but also unleashing demand that could push up prices? Well, we haven't really seen much from the administration, apart from trying to advance their tax reform legislation, but overall, financial conditions remain loose, as measured by low credit spreads. And corporate earnings growth is still considered robust, despite how late we are in the cycle. Despite low inflation, we are also seeing stronger consumer demand, particularly in housing. Will the Fed's goal to normalize monetary policy and preempt cyclical inflationary pressures by pursuing a more aggressive rate hike policy help subdue any macro credit bubbles that could form during a cyclical recovery? Well, despite record low volatility and cycle lows that we've seen in credit spreads, few credit bubbles have emerged. The Fed's commitment to current rate hike schedule has not resulted in a sharply flattened yield curve, a potential warning sign that the business cycle is in its final stages. So we seem to be kind of in this benign state where financial conditions remain loose. The Fed is seeking to normalize rate policy, but none of this has really translated into end-of-cycle weakness that we typically see, such as an inverted yield curve. Heading into the fourth quarter, we have what appears to be 1. A bottoming dollar, 2. Fed rate hike prospects, 3. Quantitative easing phase-out by the European Central Bank, 4. More synchronous global growth, 5. Likely U.S. tax cuts for businesses, and 6. Reflationary headwinds turning into tailwinds for cyclical earnings. For now, the pendulum has swung back towards cyclical growth from deflationary fears. This may breathe new life into the reflationary trade, but the world still suffers from global overcapacity, over-indebtedness, weak nominal wage growth, and low inflation. This quarter, we continue some of the same things, tracking what we've seen for the better part of the year, which is mainly the outside the U.S. International markets are outperforming the U.S., led by emerging markets. The synchronous global growth that we've been seeing has allowed the ex-U.S. markets to effectively catch up to the U.S. Fixed income was slightly positive. It actually had rallied quite a bit in August when the 10-year rate reached a year-to-date low of 2.1%. But then rates had spiked back up in September, and that basically led to a near flat return for fixed income. However, high yield continues to do well, and even though the dollar did get some strength back in September, overall ex-U.S. bonds also performed well, primarily driven by currency. The 10-year yield, as I mentioned, dropped to a year-to-date low of 2.04% over hurricane fears, but then rose to 2.33% at quarter end when the worst-case scenarios did not materialize. As for commodities, you can see a strong quarter, which was led by oil prices, which had recovered to the $50 barrel range, based on renewed demand for industrial metals out of China. As I mentioned earlier, we saw a late quarter surge in small caps. Small caps had been lagging the larger caps for a better part of the quarter up until the last couple of weeks of September. Value also made somewhat of a comeback, although it did lag growth this quarter. Value, led by financials and energy, did make a third quarter comeback, but growth continues to be propelled by the strong performance of the technology sector. Mentioned earlier the volatility sandwich. This is just a picture showing of what the VIX did over the course of the quarter. You can see that in July it had reached record low levels, only to spike back up over the North Korea fears, as well as concerns about what was going on in DC, and then that and then once the hurricane fears had passed, volatility dropped back down to near record low levels again. So we remain in a low volatility environment. So despite the surge in long-term Treasury yields that we saw at the end of the quarter, forward inflation expectations remain below 2% and are well below their highs at the beginning of the year. So in a way, Treasury yields just responded from what would consider to be overbought conditions in August. Again, over fears of what the hurricanes were going to do, what was happening with North Korea. And then that safety trade essentially unwound itself. But it's not really showing it up in the way of either forward inflation expectations or in the term structure itself. We did see a small relief rally in the U.S. dollar at the end of the month, and really this reflects a reaffirmation of the U.S. Federal Reserve's economic outlook, which is supporting a rate hike. We'll likely see a rate hike in December and 2 more next year until we reach the normal level. There are renewed concerns over populism in Germany and uncertain electoral prospects for the incumbent Liberal Democratic Party in Japan, which have weighed on their currencies, and that can explain some of the dollar strength as well. This was another good quarter for international markets, although emerging markets did give back a bit of its leadership at the end of the quarter. European investor sentiment did hit a roadblock, however minor remains to be seen, following the September 24th German elections that saw the vote share of mainstream parties hit post-war lows and the surge of populist nationalist Alternative for Deutschland, or the AfD party, from nowhere to the third largest party with 13% of the vote. Although expectations are for German Chancellor Angela Merkel to form a coalition with the German Free Democrats and the Green Party, some are speculating that Merkel will find it difficult to push through major legislation with such an unwieldy coalition, and that she may not last her full fourth term. The election could also chill the prospects of further Euro integration being pushed by newly elected French President Emmanuel Macron. The euro weakened versus the U.S. dollar following the election, and it may give pause to some who have been vocally bullish on the continent. Rising on nationalist sentiment against North Korea's threat, Japanese Prime Minister Shinzo Abe called for a snap election, hoping to solidify his party's power in parliament. But just as with Theresa May overestimating Tory support in the aftermath of the June UK elections, investors are concerned that Abe may have overplayed his hand as the opposition parties are uniting around a new party formed by popular Tokyo Governor Yuriko Koike, who is running as a reform candidate. In terms of styles, Momentum continues its leadership, year-to-date leadership, outperforming all the other styles, again being driven by the technology sector. High dividend and low volatility styles have lagged during the recovery in risk appetite late in the quarter, and you can see that quality and value have performed in the middle. But really, this has been a story about Momentum's run and why it pays to be diversified among factors portfolio. If you're running a multi-factor portfolio, why it pays to be diversified among multiple factors. The energy markets are looking more balanced. The bottom green circle on the bottom right shows that the supply-demand gap, global supply-demand gap, has effectively narrowed from its oversupply levels over the last couple of years, and the oil prices seem to be settling into this $40 to $50 range. So key issues heading into year end, I think the big one is just going to be how are earnings tracking. In October, we'll start to see insights into earnings. There is going to be a little bit of noise around the hurricane activity, so I think more attention is going to be paid on forward comments made by management in terms of how they expect the rest of the year to track, as well as into next year. But apart from that, I think DC will also to some extent, drive some volatility based on, headline risks and whether tax reform is going to get pushed through or not. And then there's also kind of, in the shadows, the potential Robert Mueller indictments. He's the special counsel. He's convened 2 grand juries looking into, everything from questionable financing of campaigns and so forth to, potential espionage. And it's, that's more of a black swan risk, I would say, but it's still something that is out there kind of lurking around the markets, and how that will impact the markets will remain to be seen. We're also seeing an uptick in geopolitical risk around North Korea and Iran. And then I mentioned the electoral uncertainties that are emerging in Europe and Japan. Italy is going to have elections as well, but I think, not enough attention, I think, is being paid to what happened with the German elections. Should tax reform not pass, there could still be some gas left in the economic tank to achieve incremental growth, but Washington, D.C. developments will likely drive market volatility until companies provide clarity on how fourth quarter earnings are developing. For now, sentiment remains strong as we're about to enter the fourth quarter, which has typically been seasonally stronger for equities. The bond market may provide some early clues on whether investors' risk appetites begin to sour or not, but for now, equities have quite a bit of momentum heading into year-end. So that concludes our third quarter market commentary. Again, if you have any questions, please feel free to contact your 3D sales representative, or feel free to email us, and we can certainly set up a call to answer any further questions you may have. Other than that, thank you again for listening to this recording, and we'll update you at the next quarter.